Well, there is a dichotomy between beliefs and outcome. When we ask investors whether they are concerned about a weakening of the institutional foundation of US dollar dominance, the answer is very often positive. Concern about the rule of law, concern about the independence of the central bank, of the Fed, or concern about the US debt sustainability. However, when we look at the actual change in the portfolio composition, we continue to see a dominance of the US dollar. The question is why this change did not happen. Sometimes the explanation is political. I believe in reality the explanation is more operational and structural. What makes the US dollar dominant is not just the size of the US economy and the political influence that the US can exercise on the rest of the world, but it's really the depth, size of the US financial market, which are in some way uncomparable to any other around the world. The euro could be a contender, but is still incomplete due to fragmentation and lack of fiscal integration. The RMB could also be another contender, but there are still governance and capital issue and capital control. So in the end, the dollar is dominant simply because there are no many alternatives. That's what I mean by dissatisfaction without displacement. One of the most striking results of the 2026 Reserve Management Survey is that more than 80% of the respondents mentioned that they change or review their strategic asset allocation over the last 12 months. This shows how busy investors are in reviewing their portfolio in order to ensure resilience in sometimes a challenging market condition. The second important trend that we are seeing is a clear continuation of diversification. Diversification across asset classes, diversification across regions and countries. The third one that I would like to mention is really about the view that they have across all asset classes. The asset class which is expected to perform best over the next few years is equity. This is quite surprising considering the last year was the year of gold. Investors are looking at the equity driven by the AI revolution and, more relevant, by emerging market. This is probably the beginning of another phase of the diversification journey of reserve managers started more than 20 years ago, and I believe the main beneficiaries are going to be emerging market in the next few years. I would say the reserve managers are not overreacting, they're not panicking, but they are adjusting to these new geopolitical realities. What we are seeing is an inclusion of geopolitical factors into long-term strategic asset allocation. Another remarkable trend with regards to geopolitics is that we are seeing what I call the return of economics. In other words, the reserve managers tend to react to geopolitical events only when the geopolitical event have significant implication for economic and financial variable. A good example is the Ukraine conflict. The reaction of a reserve manager and in general investor has become more visible when this event clearly impact, for instance, inflation or the interest rate outlook. This was exactly the case with the Ukrainian conflict. We had energy price going up, and then we saw inflation going up and central banks changing their views about interest rates. And that's when investors tend to change or alter their strategic asset allocation.